Hello, everyone. Thank you for joining us. My name is Daryl Urbanski, your host as always. And today we are joined by Christine Healy, the founder of Healy Pre-IPO, where she helps investors access private tech stocks before they go public. A trusted voice in private markets, she has closed over 600 million in unicorn transactions, including shares of SpaceX, OpenAI, and Stripe. Before launching Healy Pre-IPO, Christine served as portfolio manager and head of private markets at Destiny, the first public fund of tech unicorn shares. Earlier, she was a senior leader at Forge, and I've asked her to join us here today to share her story, plus what makes pre-IPO investing simple, accessible, and built on trust. Quick disclaimer, this is for information only. It is not an endorsement of any company or an offer to buy or sell securities. Investing in private companies is high risk. You could lose your entire investment. These investments are illiquid, hard to resell, and may never go public or provide a payout. Only accredited investors may participate under SEC rules. Past results do not guarantee future performance. The speaker may receive compensation in connection to some transactions. Private investments may also underperform markets and carry additional risks. So with all that said, Christine, thank you so much for joining us. How are you doing?
Doing great. Thanks so much for having me, Daryl.
Yeah, and I appreciate having you here. It's kind of an interesting angle to take, pre-IPO. So how did you even get into sort of the IPO business? Is this a field that your parents worked in, or are you kind of carrying the torch forward?
Yeah, absolutely. Before we get started, I also just want to ask everyone listening to take a moment to like this, to give you a 5-star review, leave you a comment, because you're working really hard to deliver this for people. So I want to make sure people are helping support it as well before we dive in.
Sure.
Now, would love to share my story. So yeah, a little bit. My family was involved in finance, so finance was always on my mind. But my path was initially investment banking, so more traditional finance. But at a certain point, I wanted to try tech, and I kind of stumbled into a startup that was focused on in the early years of building this marketplace for pre-IPO trades. So coincidental at first, or a bit of luck to stumble into that business, but I fell in love with it. So since 2018, I've been 100% focused on pre-IPO transactions in all different companies.
Right. I love that. I love that. So walk me through your career a little bit. You said that you got started in investment banking. So you went to school for this. I think you were at the University of Chicago. I have to double check.
Yes.
Yeah. Okay. So you graduate university, you get into it, you're a fresh grad. Was it easy? I mean, I imagine there were probably some challenges, right? In anything. What were some of the big?
No, it was not even remotely easy. There were more 3 a.m. nights than not, starting out in the bank in the junior year. So investment banks are notorious for heinous, working conditions and long hours. I would say it's even worse and more toxic than than they let it off to be. So it was really, really tough, but you learn a lot about working under pressure. You learn a lot about attention to detail and a number of other skills, which have been really valuable, like an absolute anxious attention to detail, which has actually been quite useful.
Right. So yeah, walk me through that. What do you mean? I imagine it's because you're investing money and the point is to make an ROI. And so you have to have a keen eye. You have to make sure that, because once your bets are laid, so to speak, you can't really take the chips off the table. Is that part of why? I mean, a lot of people have this idea, I think, of bankers as a very lucrative career. And some people think, they're like, if you compare a banker versus a farmer, people would think that the farmer is a harder worker, just kind of stereotype. Do you know what I'm saying? So can you speak to that a little bit? Like what actually goes into investment banking?
Sure. I think there's all kinds of wear and tear that you can put your body through, your mind through, your spirit through.
Yeah.
So there's certainly all different types of hard work. It was surprisingly, of course, it's not a physical job, but I was surprised by how much of a physical strain it actually puts on your body working till 3 a.m. And where those, I think the most I ever worked was something like 114 or 116 hours in a week.
Yeah, that's a lot.
And it was surprisingly, physical and psychologically straining going through that, where you desperately need to switch off, but you can't. You have to go back to that project and keep grinding into the early hours of the morning, or you've got a presentation the next day. So you finish the model or you finish the presentation deck at 4 a.m., but then you've got to get it to the printers to print and bind the presentation books to be handed out at the meeting the next day, or then you've got to Uber to the airport to hand off the books to the managing director before his flight. It was very much like Devil Wears Prada kind of a vibe in terms of the crazy tasks that you had to do to make some of these deadlines. So yeah, it was very stressful, but you go in and you're a bright-eyed 22-year-old and much more energetic at that age in general
Right,
anyway, and you
right.
don't really know any better. So you're just going all out, trying to
Trying to
make
make a
it and
name.
trying to
Yeah.
make it to the next level. Yeah.
So what goes into the due diligence behind investment banking? I think that's one of the things I kind of want to talk about as well, is because for some people it's a bit of a mystery. A lot of people in business, they don't have finance backgrounds, right? They're not necessarily financially literate. They're good at doing what they like. Business to me is, I think Elon Musk said business is a group of people helping another group of people, and they do it via product or service. So for a lot of business owners, they're good at doing something that helps people. And an unfortunate number of them kind of rely on word of mouth, but the more savvy ones are capable of going out and finding. It's almost like a never-ending job hunt, right? Like Apple's never going, hey, okay, we sold enough iPhones. Like they're constantly looking for more work, more market, right, to expand. So I think a lot of business people are kind of in the marketing and the sales and the fulfillment side. So as someone with an investment background and even getting into pre-IPO, you could talk about sort of the due diligence that goes through assessing investments, assessing an opportunity, assessing the situation.
I think there's all different types of bankers or financial services, just as there are different products and different clients. So you get folks that focus a lot on family office relationships, or entire groups of banks that focus on servicing hedge funds, or et cetera. So in the beginning of my career, I at first focused on energy, so power and renewables. There was a lot of M&A. So that's a certain type of advisory, or where you're um, putting together a
Mergers
strategic
and acquisitions,
pitch.
right?
Yeah, exactly. You're saying, have you thought about this company as an acquisition target? Or you're trying to get acquired. Which companies could potentially acquire you and which ones make sense? So you're constantly pitching to these corporate clients some sort of strategic initiative or corporate action like M&A or selling off a business unit or something like that. But as a junior banker, I was in investment banking 22 to 25 years old. You don't get to do a lot of that strategic work. I actually find the strategic work incredibly exciting and interesting, piecing together the puzzle of who should buy what and why, and making it make sense. As a junior banker, you're doing a lot of modeling. You're doing 80-page PowerPoint decks, and you don't really get much of a voice in the actual strategic side of it. So when I did eventually transition and become a broker and start working in the pre-IPO trades, that was so much more of a natural fit, because it was the hunting and the client matching and buyers coming to you wanting to find SpaceX or find OpenAI, and you having to find the other side of the trade from a big, basically decentralized, messy market, and thinking who in the world holds that stock or that investment they're looking for. And their perfect counterparty could be a family office, could be an individual selling employee shares, it could be a secondaries fund. And that's where you get to exercise that strategic creativity. And so that was where my career really took off. And I went from associate in 2018, and I just got promoted and moved up the ranks to senior director by 2021. So that was where it was the perfect fit. And I've been doing these kind of deals since then.
Oh, almost sounds a bit like a private detective work to an extent. Somebody's trying to get in on a company, and you have to figure out who has shares that are on the table for sale. And you've got to figure out who's involved with it. Like sounds like you get really involved in the people dynamics in a lot of cases, because you have to figure out who's holding the bag, who's got the bag, and who's got a reason to sell some of that now.
Yeah, and I love my clients. There's all different kinds of clients, from early employees at these tech unicorns that have $10 million on paper, but they can't liquidate it without a stock sale. And they just want to fund a new business, or they want to buy a home for their family. Or in some cases, it might be medical bills or something a bit less positive, but they need the cash. And there's people from all different sides of these companies, as well as professional investors like VCs as clients. So there's a whole range of folks I get to deal with, and they all have their own quirks. They all have their own needs. They all have different expertise. I learn a lot from my clients all the time too. So it stays exciting. And that's why it's nice being a broker,
Yeah.
also compared to some of the things I've done in the past where you're not directly working with clients, like
Right.
hand
So
in hand, essentially.
you mentioned an interesting situation to me. I don't know if we can go deeper into this or not. It's okay to tell me if not. You mentioned an employee who's unable to sell their stock, like it's vested for a certain period of time or something, but they want to fund a new business or buy a house or something like that. Just theoretically, hypothetically, at the top of your head, that person sounds like they're in a contract, like they can't sell their shares. Is there a creative way around that, like putting it into a trust of some sort that, like post dated checks? Like, how do you figure that part out?
Yeah, so the situation I mentioned where you're an employee at one of these companies that's really taken off, and by all accounts, you're a millionaire on paper, but that
Right.
paper isn't very useful to you because you can't buy a house with it. It's actually extremely common. So common. And companies these days are really diverging into two camps. Camps that realize they need to provide some sort of liquidity to keep their employees happy, to attract the best talent, and companies that are actually taking the opposite approach and becoming more and more strict. Companies that are prioritizing control really over everything. So there's a lot of companies that are tightening restrictions, but also companies that are getting more open when it comes to whether employees can sell or not. So
Right.
it's tough. It's tough to navigate. I personally feel that employees work hard for their stock, and once they've vested it, once they've gone ahead and exercised it, that's an asset that they own, and they should have,
Yeah.
a basic amount of optionality when it comes to managing their financial future, when it comes to that equity and being able to sell. So that's something I feel very strongly about. But some of these companies and some other folks in the industry feel companies could lose control if they let anyone trade freely. So it's a bit of a controversial topic, but there are different structures that have come up in the market. So some of the companies that realize they have to give liquidity, there's not an option to block it completely. Some of them are doing these mega tender rounds, so they
Okay.
still stay private. They don't let people trade independently just with a random broker, but they'll arrange a company sponsored liquidity program where everyone might have a window to sell once a year or once every 2 years. And if you want in, this is your time to sell, and the company kind of arranges it. So that's one method that's popped up. And there's also different structures and things in the market, everything from vanilla structures like direct transfers all the way through to more exotic holding structures. So, for example, you could sell to a VC that has a close relationship with the company that could get you that approval to sell, or numerous other dynamics that come up.
Yeah, it's interesting because I don't have an IPO experience, but I do have an experience where, in my mind, I'd helped a company do a turnaround, and we did over $3 million in under 8 months. And in my mind, being kind of one of the top three key people in the company that helped execute on that, we'd won the Super Bowl, and we had a Super Bowl winning team, and we just had to keep winning games. And the next 3 years looked really good. And what happened in my situation was so shocking to me, because instead what I experienced was cannibalization of the internal team, where people pushed other people out of the company to eat their commissions. There was a lady, I'm going to try to be as vague as possible. There was a lady who was owed something like 50 grand in commissions, and she ended up getting pushed out by an incoming COO. And he ended up, I saw the finances. He ended up she got like 8 grand, and he ended up eating the rest of her commission. And it was like somebody took an axe to this team. I ended up leaving. I still got paid. It wasn't easy. I still got paid though. I always get paid. So it was just interesting to me because it was like everybody, it was like a giant money making kind of events or series of events happened, and everybody took their focus off of driving the bus and kind of
Mm.
started fighting over the lunchbox, and the bus went off a cliff. I mean, I followed up they did well for the next kind of 12 months, but then I heard they took a $400,000 bath, and I think that's a big part of why. So it's just interesting because I understand what you're saying. I'm just playing devil's advocate a little bit. I was thinking about what you're saying, like companies understand, and I agree, like as an employee, I want to make the money, like I'm working to make the money. But also from a company standpoint, if you invest so much in infrastructure and IP, and you got to make hay when the sun's shining, that employee's stock could be worth a heck of a lot more if people just stay focused on the goal versus, oh, I got it, time to make a big sale. Now I want to go on vacation. Now I want to go buy the new car and I want to drive it. Now I want to go. And that's, I think that's a challenge for everyone involved. And I don't think there's an easy answer, but just when I was thinking about that, I thought it might be relevant to share as you talked about that. So, but I digress. So for people that are unaware, how do you know who's going to do an IPO? I mean, that sounds like when a company, goes public, for the people that are on the ground floor, that's a big payday for them because of the hard work and toil. How did the stranger just like party crash and be like, hey, I want to get in at 10 cents a share when we think it's going to go up to $3 in like a week?
Yeah, well, we don't always know which companies are for sure next on the IPO docket. That's always a huge question mark. But you can look at a certain class of companies that have that institutional caliber of investors that have reached a certain scale of valuation. They might be unicorns or decacorns or even larger. I mean, some of the pre-IPO companies these days are
Insane.
300 and 400 billion. I mean, SpaceX just hit 400 billion in valuation. So when you hit that sweet spot of scale, of business maturity, have Stripe that hit over $1 trillion of payments volume. We don't necessarily know that they're going to IPO soon or not, but we know they're at a scale where we would still call them a pre-IPO company because they've reached a scale and a maturity where they could feasibly be a near-term IPO. So those are really the companies that my investors tend to target, those true pre-IPO companies. Whether or not they end up IPOing, they have the characteristics of a company that could. So
Right.
SpaceX is interesting because as far as we can tell, Elon has no intention of going public anytime soon, but
Right.
you'd still call SpaceX a pre-IPO company. And that's because they're north of $400 billion valuation at this point. And they have all the traction and demand that they potentially could go public, even though it could be 10 years down the road or however long. But it doesn't always matter. I think the interesting thing is that in the past, VCs and other private investors saw the IPO as the golden results, or that's their preferred exit avenue. But the interesting thing is that as these trading markets become more commonplace and really more liquidity and activity comes to the market, there's also a new avenue of exit, which is you could potentially hold your stock for a few years and then resell to another private buyer.
Right.
Even if the company itself hasn't IPO'd yet. So that's a really interesting new avenue that's coming up because some of these companies just continue to delay their IPOs.
Right.
And so some of those original investors are saying, hang on, well, now I want liquidity. How do I get out of my position if their circumstances have changed? So it's never a slam dunk. It's never guaranteed. Regulations require you to buy to be a long-term holder. But there's the potential sometimes, depending on the circumstances, to actually resell to a private buyer down the road, which is a really interesting new dynamic.
Yeah. So can we talk about that? Why go public? Like if you're doing 100 billion, I think we're going to see our first one person $100 million company with AI and how it's empowering people. I think we'll see some psychopath that's just doing everything that they can and they've just built all these systems around them. But that aside, if you built a company to 100 million, 10, 50 million, is why go public? What you talking about the different characteristics and almost behavior or personality of the company. Can you describe for us why two use cases, one where they would never go public? Is that just more of like a values position on the founders? Is there, you know what I mean? Like, are they leaving? What's the advantage? In my mind, and I'm not an investment banker, and I honestly don't touch stocks because I stick to the things I understand. And for me, it's like Wolf of Wall Street, like it's a wooey woo foo. Like I understand. I understand marketing campaigns. This marketing campaign's got a 3x or 7x ROI. I understand that. So I try to avoid that, but it is what it is. Maybe I just don't have enough money. But yeah, so for me, the IPO is always like a way to raise money to grow the company faster. That's part of why you would do it, would be to access more capital without necessarily incurring any debt. And so it's almost a way to get free money to fuel your growth dreams and your R&D projects and build a moat around what you built. But if you build something, depending on the size of the market, for some markets, 30 million is the cap, right? You've reached market saturation. So what is, like you said, some of these are pre-IPO. Can you just, I'm rambling now, but kind of two personalities, why one would, or why, I mean, do you already describe it, or why wouldn't someone go IPO? You say like there's demand and pressure.
Yeah, it's a great question. I mean, there's no denying that there are certain benefits to going public. For one, your investors that have been with you since the early stage get their chance for liquidity. And especially if they've been holding a really long time, that tension would otherwise keep mounting and mounting and mounting. If you're, for example, Reddit was close to 20 years old when it IPO'd, which is kind of unheard of for tech giants in past years. So if you're at the scale and maturity where you look like one of the companies that would IPO, but you choose not to, you're going to be facing an almost constant pressure from your investor base. Like, where are we going to get some kind of liquidity, or we're holding, or our fund life is coming to an end. We need to get some sort of realized return. So there's that kind of reality if you've gotten to the IPO stage, but you've just chosen not to. And as you mentioned, you get access to the public capital markets and a number of other things that you can do when you're a public company versus when you're private. So that's kind of personality one. But personality two is really these giant tech companies that have already reached unicorn or decacorn status. So I specialize in really unicorn or close to unicorn plus. So we're talking billion-dollar, multi-billion-dollar tech companies specifically. And I specialize in tech versus other companies. So AI companies, space companies, or companies in a variety of verticals. It could be food, or it could be biology, or whatever, but that touch on tech, like Neuralink, or like Impossible Foods, which is kind of like alternative proteins type of tech, but it's all tech. So specifically within the tech universe, and when you're talking about these really large tech companies, that persona is, let's say, a founder like Elon Musk and his private companies. So there's XAI, there's SpaceX, there's Neuralink, Boring Company, etc. Elon's notorious for wanting to stay private as long as possible. And usually the reasons are control. So control over your investor base. You don't want a ton of retail people or the open market accessing your stock. You also don't want to have so many shareholders that you're forced to be public, because there's rules and regulations around number of shareholders as well that you have to be wary of. And you really just want to stay focused on your mission. So Elon in the past has said things like, we don't want to go public until there's humans living on Mars, or something to that effect. So there's the idea that if you're a public company and you have to deal with regular disclosures to the public, and you have all these other burdens, or you have to worry about if your stock is up or down on a daily basis, and sometimes macro forces outside of just the direction of your company itself, there's a lot of distractions and there's a lot of pressures other than just running your company. So if you're one of these high-tech companies that's trying to achieve a frankly really difficult moonshot goal, like people living on Mars, building a new high-tech space station, in the case of Axiom Space, or some of these other companies, you want to stay focused on that. You don't want to have to worry about the additional pressures that come from being public versus being private. So that's a huge consideration too. And then there's also the factor of you just may not need to, because if you can satisfy those pressures from your investor base that I mentioned by allowing a company-sponsored liquidity program, so get those people satisfied that are hankering for some sort of exit, and then continue being private, it's kind of like the best of both worlds in a sense to some of these companies. So if I was in the CEO seat, I don't know that I'd be rushing to go public either, quite frankly. And I've also seen certain companies that maybe were grappling with multiple options and ended up choosing to go public, and in retrospect might have been better off continuing to build their business privately and have since been slammed on the public market, and it just may not have been a necessary move.
Right. Yeah, it's tough because, like you say, the advantages are there, but then you lose control, and then your focus becomes on appeasing shareholders as opposed to, it's interesting because in my mind, I learned about business kind of grassroots, from the ground up. And so for me, businesses really do focus on solving problems. And I've noticed the different personalities, and you need them. I don't want to say this. I'm about to say some things, and I don't mean it in any sort of negative or derogatory way. Part of it's what I've seen. And so typically you have a founder that has a mission and a vision and a purpose, and they build something and they do something remarkable. And it grows and it grows and it grows and it grows and it grows. And then sort of the accountants and the lawyers come in and the managers, because often the founder is a creative type person that has to constantly create, not always, but a lot of times. And so that's where you don't necessarily get the scale that you could. Like I always think businesses is a little black box that solves a problem. And if you solve a problem really well, it's almost your duty to the world to get as many people on the planet that have that problem to use your black box to go through it. If at the dentist office, you go in crying on this side and in pain, you leave smiling with a beautiful smile and pain free on the other side. So you're on a mission to find all the people on the planet that you can help. But again, with the founders, sometimes they're obsessed about a specific technology or whatever, and they never really take it as far as it could go. And so the accountants, the lawyers, and the managers come in and they help stabilize it and scale it. But they're not the original spark. And so then it becomes, and we feel this, I think that's why we don't like monopolies. I think that's part of the reason. Again, we said a disclaimer at the beginning, but I'm sharing, it's my podcast, I guess, so I'm sharing my ideas, but it can almost become I already said before, cannibalistic, where you have people that are trying to figure out how do I increase income and sales, but they don't understand how the value was created in the beginning. And so then they start finding loopholes. And then you just end up with this giant conglomerate thing that's a bunch of management by committee, and everyone's trying to figure out how to get an extra bonus. And they're worried about the shareholders, and they're not focused on the original problem that everything was built to solve. And that's not necessarily true in every case. And I'm not, like I said, I'm not trying to throw shade, but I was thinking about that. There's also a study that was done. Sorry, I've lost my voice 2 days ago. We said this at the beginning. It's almost back. But these guys, I think they're out of Switzerland, did a study, the network of global corporate control. And they basically did a mathematical analysis. Stefanani Vitali, James B. Glatterfield, Stefano Battiston. And they did this mathematical analysis and basically came down to something like 50 companies, 700 individuals control 51% of all the world stock exchanges. Your Goldman Sachs, State Street, Bank of America Corp, Citigroup, Morgan Stanley, Dutch Bank, Barclays, USB, BS, Lehman Brothers. These are your JP Morgan, Merrill Lynch. The sort of network of corporate control, or it's centralized. And I think that when you talk about Elon, that might be part of it too. I think if the founder's still involved, maybe that's not your concern. Your concern is helping the people that are just trying to find a safe place to put their money. Because the flip side of this coin is between inflation and depending on what's happening with other economies in the world, people are just trying to preserve value. Can you speak to that at all? Is there, when you're doing a pre-IPO, is there, we can't guarantee earnings. Nobody knows the future. But is there like a benchmark ballpark that you always kind of, or someone would always aim for in an investment?
Well, I agree about a few things. I mean, it's a chaotic world. There's a lot of volatility. There are investors out there that are trying to preserve value or take a safer route. Those don't tend to be my investors. My investors tend to be risk on type of people. So I am, as a broker, I am not shy about saying I offer high risk investments. And I have to be very forthcoming about that because it's not for every investor. So the type of companies I deal in from SpaceX, OpenAI, Anduril, Anthropic, etc., they seem like large, highly scaled companies. Like I said, they fit that category of a pre-IPO company or a company that could IPO. But things always happen and they're high risk assets. So you see cases like FTX, right, that reached, I think, close to 40 billion in valuation and then completely imploded as a company. Or you see 23andMe, which when I started my career was really actively traded on the private markets and has since gone into bankruptcy or liquidation and gone down. So there is real material risk, but people that invest in these high-tech private companies are looking for a combination of things. They're looking for outsized returns, hopefully, but also balanced with a bit more visibility and a potential IPO horizon. So if you were going ultra risk heavy, that might look more like traditional venture capital, where you're investing in these seed stage companies or you're on Shark Tank or you're something like that, where traditionally in early stage venture, you expect that most of the investments will fail. Or you're just looking for that one company that might just, I don't know, have a 1,000x return or some crazy return, which makes up makes up for all the losses of the whole portfolio and then some. So that's not exactly the same risk profile. The risk profile of these pre-IPO companies, which we also call ultra late stage, is hopefully high returns balanced with a bit more company maturity. These are companies which in some cases, like I mentioned, Stripe, where you have over $1 trillion in payments volumes relative to the early stage stuff, where it's kind of a crapshoot and you're looking at much less in terms of traction and track record really to go off of for those investments.
Yeah, that makes sense. Yeah, I got to go to a conference. I went to a conference where I got to meet Naval and Brian Johnson on the same day, which is kind of cool. And I also met this guy in Europe that was a VC, venture capitalist. And he was talking about, if you've got a fund of 50 million, you're basically looking for 50 plus deals that you can do that are each going to make you 50 to 100 million. And that's ultimately what they're looking for. Where can I place $1 million if just one of these pops? And so I think that's super interesting because, man, you got to kiss a lot of frogs to find an opportunity that I could put, that's like early stage Bitcoin.
Yeah, for me, I don't like the early stage stuff. I've tried it. I've tried it here and there, but I don't personally want to put my money in something where I put in 10 things and 9 of them fail. I mean, I don't love that as an experience. Maybe my risk appetite is more moderate than extreme like that. But yeah, I've tried to dabble in the early stage stuff, but it's so different from the late stage VC that I do. It's like a whole new universe, really.
Yeah. So can you speak to that? What do you see coming down the pipeline in the next 3 to 5 years? There's a lot happening geopolitically. There's a lot happening in the tech world with AI. What are you keeping your fingers on the pulse of?
You're seeing a lot of AI companies, both existing ones and new ones popping up, that are becoming highly funded very fast. And, some of my clients say there's too many business models out there. There's, I don't know, 400 or 4,000 companies that are valued at $1 billion or more. It's not sustainable that all of these will succeed. A bunch of these might go bust, or we're in some kind of AI bubble. That could be true. But it's also a possibility that we're going to see just a ton of value creation from some of these new AI ventures, as well as companies that are an application of AI. Maybe they're applying AI to military drones, or maybe they're applying AI to another industry. So I think we're going to see a ton of value creation across different industries and different verticals powered by AI potentially. So within the private markets, AI is one of the highest demand types of company right now. So you see demand for private companies like Anthropic, OpenAI, xAI, Scale AI, and a bunch of others too. It's really one of the most popular industries. But then you also see historically popular industries, like I mentioned, like space and SpaceX and Axiom Space and other companies, as well as fintech like Stripe, Klarna, Revolut, and others too. So AI is for sure a popular theme of the moment, but balanced with interesting growth in other verticals too. And I think we're going to see more and more companies continue to delay IPO for all the reasons we've discussed. So there's a lot of people saying, well, the IPO climate looks all right. You have a few examples, or you have the Circle IPO that did pretty well, at least so far. Maybe more companies will look at the markets and decide if they've been teetering on that borderline of should they go public or not. Maybe now's the time. And a lot of people are saying we're going to get a slew of IPOs. I think we're going to see a lot of the IPO pipeline be cannibalized by these company liquidity programs and by these giant companies that are following in Elon's lead and saying, maybe I actually don't have to go public for several years longer. So I think that's going to continue to be a trend. And what that means for everyday investors is that unless they're active on these private markets, they continue to be locked out of investing in some of those well-known companies that they love the most. So when you think about a company like SpaceX that just reached 400 billion and it's still not on the public markets, all those people out there that would love to have a financial stake in what they consider one of the most innovative companies of our generation, but while it's still on the private markets only, you just can't access it in the same way. And so there's a big access problem, in my opinion, as these companies decide to stay private longer and longer. So that's really why I think my work is so interesting, because I get the pleasure of working with a lot of individual investors. They might be doctors or business owners or whatever it may be. And they've been following SpaceX or some of these companies for years as a bystander. And they're sick of being that bystander in really our future. And they want a stake and feel like it shouldn't just be the venture capitalists that get rich off of some of these innovations. So it's really cool to actually work with individuals and help them get in the door by finding them a trade while it's still private.
Yeah, I love that. So what do you think are the biggest mistakes people make when they try to do pre-IPO?
It's such a good question. I love that you brought that up. So one thing is that pricing in the private markets is not uniform. So a lot of people, especially if they're used to just investing on the public markets, whether it's on their Robinhood account or their Fidelity, you look up a stock you want, you get a view for the market, it's all in one place, you can just buy it there and then. In the pre-IPO markets, all different sellers can have different prices and different structures, even for the same company's stock. So that can be such a big adjustment because a lot of buyers essentially realize they have to end up hunting for what they want. Or if they just take the first deal that's being offered to them, or they see SpaceX or some company on a crowdfunding platform or offered through someone that might not be reputable or might be a bit shady or whatever, they don't always understand that you can't take everything at face value. You have to really double click and understand what's going on and discern the right deals from the wrong ones and so on. So the market's really fragmented. It's not like a public stock where you could just go on one platform and find exactly what you need and buy it there and then.
It's almost like a high-end garage sale, it sounds like to me. Not to be reductive, but that's almost what it sounds like. It's like a neighborhood garage sale. You might find a lamp. This guy's got a lamp, they got a lamp, but everyone's kind of trying to get what they can get. It's not standardized in any way.
Exactly. It's not standardized, and that makes it really difficult because how do you know if you're that surgeon and you don't work in these markets every day? How do you know if the price you're being offered is at the high end of the market, the low end of the market, if it's right on the money? And some of these deals go quite quickly. So you need to develop that amount of confidence in what you're buying and be decisive, in some cases quite quickly. So that's where a broker steps in to try and contextualize pricing, walk people through the structures, help source ideally a range of offers for someone to look at and compare. And so you have a bit more context on what you're looking at if you're that surgeon that doesn't just walk in with that expertise, or you don't have the time to do your 10,000 hours to get up to speed in this crazy pre-IPO world.
I love that. I love that. Yeah, I mean, I'm backtracking a little bit here. You talk about AI. I think the focus is on all the big ones. Even the founder of NVIDIA, the AI chip company, he did an interview, and I really appreciated what he said. He said that he thinks the future is in specialized use cases of AI. Everyone's focused on the AGI, the general AI, but more and more, specialize are outperforming, like specializations outperforming. And that made me think of Adam Smith's Wealth of Nations, written the copyright like over 100 years ago. He talked about the specialization of work and economies of scale. Almost, he talked about if you had one or two people building it. I think the example was making pins, like needles, like sewing needles. They might do 40 in a day, but if you have a group of 10 people, or sorry, if you have a group of 5 people, they'll do 10,000 in a day. And it's because everybody specializes in their specific role. So it sounds like you said, there's going to be a lot of value created in the AI space because all the big players are kind of breaking trail. And I think a lot of these small, you say it's such heavily invested right now. I think if anyone can have a really specialized use case, I think Lovable went to $1 billion valuation in something like 6 months, something ridiculous. There was a no code. It was like, a conversational coding tool. So yeah, I think, how optimistic are you? Because a lot of people think that we're headed for a crash. Some people think they should hold their money close and hold it tight. Other people are trying to jump to a crypto coin of some sort. What's your input on that?
Yeah, it's tough. I mean, sometimes when like we had the tech markets crash 2022, 2023. That was a huge crash for my industry and for tech stocks in general, both public and private. So all of a sudden you saw some of these private tech company shares trading at huge discounts to their last VC round. And it was like that for a while, really, because 2021 was so overheated. 2021 was such a hot year. And so that made the crash of 22 to 23 even more pronounced, really. So the big macro trends do, in a lot of cases, affect the markets for these private companies, but there are also kind of exceptions. So if we look at past years, you also had some of these big tech giants like SpaceX that were a bit less correlated to the markets and a bit less correlated to the volatility. So even in those years, 22, 23, when so many of these tech stocks were crashing in virtually every industry, SpaceX still managed to do new tender rounds at incrementally higher pricing roughly every 6 to 8 months. So SpaceX was going up and up and up, while almost every company was getting obliterated otherwise. So I think that's going to affect the volatility, and all that is going to affect the choices of some investors for sure. Even within this pre-IPO deal landscape, you have different types of investors. So some are looking for companies that have much more financial data visibility. So there's companies like Klarna that have been pretty good about putting all kinds of financial milestones and stuff like that out there publicly, and that's a priority for some investors. You have some investors that are going for companies that really could be on the brink of IPO and could be in the next batch of IPOing companies. And so an exit is a top priority. You have other companies that are looking for a bit more liquidity. So even though these private equity deals are illiquid, some investors want a more active market where it might be more likely that they could resell in future. So it's so interesting, and that's what keeps this job, I think, still exciting after 7, 8 years, because there's all different trades for different folks. So all this to say, there's some investors that look at volatility and they want an asset that might be less correlated, and then they might go for something like SpaceX, which at least historically has been less correlated with these wild swings in the broader market.
Right. Hey, Christine, this has been a great interview. I've got a couple of pages of notes. People may want to go back and re-listen to it to make sure they got all the gold nuggets. Is there anything I haven't asked you that I should have asked you?
Yeah, I don't know. I mean, I could talk about this stuff for days. It's really my passion. I love helping people, especially individuals, to get access to companies that are really hard to access otherwise.
Right.
So you've talked a lot about how a visionary founder might be great for one stage of company, but how do they take it to the next level? I
Right.
think it's hard to take it to the next level. I think the skill set that makes you great at business at one stage of company is not the skill set that gets you to be a $10 billion company, right? So the difference between me and other operators in my space is I'm not even trying to build a platform to be a $10 billion company. My main competitors in my space right now are trying to raise VC funding. They're literally vying to be a $10 billion private equity, ecosystem.
Right.
I'm saying you inevitably lose quality when you make that transition, and I'm not willing to compromise quality for my clients. So I'm on purpose a small boutique broker business, and all my clients work one-on-one with me. Every transaction that comes through my company is handled personally by me. And so when all these other businesses are going for scale, I'm going for quality of care. So my business is a concierge service. That's front and center. So in markets where it can be very confusing and overwhelming, where it takes a lot of time to learn how to discern the right deals, really, where there's bad actors sometimes or offers that you don't find reliable, and a market where pricing is not uniform, and one seller might have a totally different structure and price than another seller over there. So in this crazy chaotic market, it can really help to have an experienced person working directly with you rather than being just a number in the database of a super, super large company. So that's my passion. That's where I love to play. And if people do want to learn more, I'm also really passionate about getting free education out there. So I have a mailing list you can sign up for at healypreipo.com. I'm also all over LinkedIn talking about different topics, and you can find me there too under Christine Healy.
Yeah, great plug. Let's say that again. So go look up Christine Healy, Chrisistine, Healy, Healey, or you can check out Healy Pre-IPO, HealeyPreipo.com. You can get on the newsletter at /sign-up. You can go to HealeyPreipo.com/sign-up. Christine, thank you so much for joining us today. It's been an honor and a pleasure. Thank you for coming, knowing you've got your own community, your own direct reports, your own clients you'll be talking to. Thank you for coming and speaking with my audience tonight so we can all understand this industry a little bit better.
My pleasure. Thanks so much, Daryl.